The world once appeared stable. At the height of their power, the great empires looked durable, almost permanent. Their borders stretched across continents. Their currencies were accepted far beyond their capitals. Their armies were funded, supplied, and paid on time. On paper, their systems worked. At the time, few questioned the foundations. Trade moved steadily through established routes. Tax revenues flowed in predictable cycles. Administrative offices functioned with routines refined over generations. Behind the scenes, clerks recorded numbers that seemed reassuring. Surpluses in one year balanced shortfalls in another. Credit filled the gaps when timing failed. It seemed logical. History often remembers these eras through spectacle, victories, architecture, leaders, the rise and fall of dynasties. The common explanation for imperial decline usually arrives later, packaged as moral decay, military overreach, or cultural stagnation. But during these periods of apparent stability, those explanations would have sounded strange. Rarely discussed was the quieter mechanism holding everything together: money, not wealth in the abstract sense, but the practical system used to move resources through time. The way expenses were met before revenues arrived. The way obligations were postponed without being erased. The way confidence itself became a financial instrument. In every major empire, the same condition existed at its peak. The state had grown large enough that its ordinary income could no longer cover its ordinary costs at every moment. Armies had to be maintained year-round. Infrastructure required constant repair. Bureaucracies expanded to manage distance and complexity. None of this happened suddenly. Gradually, rulers and administrators adopted a solution that appeared harmless. When revenues fell short in a given year, they borrowed. When unexpected costs emerged, they borrowed again. When old obligations matured, they were replaced with new ones. The practice did not feel dangerous. In fact, it felt responsible. Borrowing allowed stability. It smoothed disruptions. It avoided unpopular tax increases. It preserved political calm. More importantly, it worked at least in the short term. Few noticed that something subtle was changing. Debt was no longer an emergency tool. It was becoming a structural feature. At first, loans were tied to specific needs. A war, a harvest failure, a sudden construction project. Each obligation had a reason, a justification that made sense to those approving it. The paperwork reflected control. Over time, the language shifted. Borrowing was no longer described as temporary. It was described as normal, expected, integrated into annual planning. On paper, repayment schedules extended further into the future. Confidence replaced caution. This confidence rested on an assumption rarely questioned at the time: the empire would always exist to pay. As long as trade continued, as long as taxes could be collected, as long as the currency retained trust, the system appeared sustainable. Creditors believed this. Administrators believed it. Citizens rarely had reason to doubt it. The empire had always paid before. What history often misses is that this moment when borrowing becomes routine rather than exceptional is not marked by crisis. There is no collapse, no visible strain. In many cases, it coincides with prosperity. The roads are maintained, soldiers are paid. Markets function, life continues. This is why the mechanism remains invisible in most narratives. Debt does not announce itself as danger. It announces itself as relief. Behind the scenes, however, something irreversible begins. Each new obligation slightly reduces future flexibility. Each postponed payment narrows the range of choices available to the next decision-maker. The system becomes less resilient, even as it appears more efficient. Years later, historians would point to invasions, rebellions, or political fragmentation as turning points. Those events are easy to see. They leave dates and names. The financial structure that made those events unmanageable is harder to trace. At the height of empire, the mistake is not obvious. It feels like prudence. It feels like continuity. It feels like strength. Only decades later does it reveal itself as dependency. Most historical explanations stop too early. They focus on moments when pressure becomes visible. A defeated army, a contested succession, a province lost. These are presented as causes, not symptoms. The narrative lens settles on the surface event because it is concrete and dramatic. What it rarely examines is why these moments could no longer be absorbed. Empires had faced military losses before. They had endured bad rulers, regional unrest, and external shocks. In earlier centuries, they recovered, borders shifted, but the system held. The difference, quietly, was financial. At the time, administrators did not think in terms of collapse. Their documents show a different concern: continuity. Payrolls had to be met, contracts honored, grain shipped, ships repaired. The state could not pause simply because revenues arrived unevenly. Borrowing solved this mismatch. It allowed the present to function without waiting for the future. Taxes collected next year could pay soldiers today. Trade revenues expected next decade could justify construction now. On paper, this alignment of time appeared efficient. Few noticed that time itself was being compressed. As debt accumulated, the empire's future income became increasingly spoken for, not lost, just allocated in advance. Each loan assumed stability. Each renewal assumed growth. Each extension assumed that tomorrow would resemble yesterday. This assumption rarely felt reckless. Empires had reasons to trust it. Their populations were large, their territories productive, their institutions experienced. Creditors competed to lend, often at favorable terms. Interest rates reflected confidence, not fear. The presence of willing lenders reinforced the illusion of safety. As borrowing normalized, something else changed quietly. Policy began to orient around creditor expectations. Decisions once guided by administrative needs started to account for market reaction. Maintaining confidence became as important as maintaining roads or armies. This shift did not feel political, it felt technical. Budgets were adjusted not to maximize resilience, but to preserve trust. Taxes were structured to ensure steady payments rather than long-term productivity. Short-term solvency became the primary signal of health. On paper, the empire still looked strong. The cost of this arrangement was not immediate. In fact, for long stretches, it produced calm. Social unrest was deferred. Infrastructure remained intact. Military readiness was preserved. The price was paid elsewhere. When unexpected shocks occurred, options were limited. A drought no longer meant temporary relief, it meant renegotiation. A military loss no longer meant regrouping, it meant refinancing. Each disruption required financial accommodation before strategic response. Gradually, decision-making slowed. Not because leaders hesitated, but because flexibility had been sold forward. Choices that once existed no longer did. Raising taxes risked unrest that markets would notice. Cutting spending threatened services that maintained order. Default was unthinkable. The system became brittle without appearing weak. This is why later crises felt sudden. When pressures finally exceeded tolerance, the response capacity was already exhausted. What looked like a political failure was often a financial inevitability. Importantly, no single actor caused this outcome. The borrowing decisions were dispersed across decades, made by different rulers, councils, and administrations. Each acted rationally within their moment. Each solved a real problem using the tools available. In hindsight, the pattern becomes visible. In the moment, it did not. Debt, once embedded, changes the relationship between state and time. It pulls future capacity into the present, leaving less room to adapt when conditions change. Empires do not fall when they borrow. They fall when borrowing becomes the condition for normal operation. This is rarely acknowledged in popular history because it lacks a clear villain. There is no invasion to dramatize, no betrayal to condemn. There is only accumulation, quiet, gradual, logical. By the time the consequences become undeniable, the decisions that created them are far in the past. The individuals responsible are gone. The paperwork remains. What follows is often misread as decline. In reality, it is constraint finally becoming visible. The empire does not suddenly fail. It simply discovers that it has already spent its future. The moment of no return rarely announces itself. It is not marked by panic or public debate. There is no ceremony. Often, it appears as a minor administrative decision, approved quietly, recorded precisely, and forgotten almost immediately. At the time, it feels like maintenance. By this stage, borrowing is no longer a response to disruption. It is part of the system's baseline. Annual budgets assume rollover. Maturing obligations are replaced automatically. The distinction between revenue and credit blurs. On paper, nothing dramatic happens. The empire continues to function, its officials remain competent. Its institutions retain their form. Trade still moves, courts still rule, armies still march. What changes is the direction of dependence. Earlier borrowing relied on future income that was still flexible. Now, future income exists primarily to service past commitments. The order reverses. Policy no longer shapes finance. Finance shapes policy. This shift is subtle because it presents itself as responsibility. Administrators speak of discipline, of credibility, of honoring obligations. These are not controversial goals. They are signs of seriousness. Creditors reward them. Markets respond favorably. Interest rates remain manageable. Confidence persists. Behind the scenes, however, the empire's margin for error narrows further. Projects that do not generate immediate revenue are delayed. Maintenance replaces innovation. Long-term investment yields to short-term assurance. This does not look like decline. It looks like caution. When external pressures increase, the system adapts just enough. A new tax is introduced, narrowly targeted. A monopoly is granted. A province is asked to contribute more than before. Each adjustment is modest, each one makes sense in isolation. Collectively, they alter the internal balance. Regions once integrated by mutual benefit begin to feel extracted rather than included. Local economies adjust around imperial needs rather than shared growth. Compliance replaces participation. This change is rarely recorded as policy. It emerges through practice. At the same time, the empire's reputation shifts quietly. It is still powerful, but less generous. Still orderly, but less forgiving. Still respected, but increasingly transactional. Creditors notice this before citizens do. Lending terms tighten imperceptibly. Not because default seems imminent, but because risk is reassessed. New conditions appear in contracts. Oversight increases. Assumptions are formalized. None of this signals collapse. It signals maturity. The point of no return is reached when the system can no longer imagine operating without credit. When even stability requires borrowing. When peace itself must be financed. At that stage, alternatives are theoretical. Raising taxes significantly would disrupt fragile balances. Cutting spending would expose structural dependencies. Reorganizing institutions would take time the system no longer has. Every path forward assumes continued access to credit. This is the moment history often mislabels as decadence or mismanagement. In reality, it is constraint meeting reality. The empire has optimized itself for continuity under stable conditions. It has not prepared for deviation. When deviation arrives, response options are limited. A shock does not have to be catastrophic. A sequence of poor harvests, a shift in trade routes, a technological change elsewhere, a competitor offering better terms. Any of these can be absorbed if flexibility exists. In this phase, it does not. Instead, each disruption triggers a financial response first. Emergency loans, accelerated collections, asset pledges. Strategic decisions follow, shaped by the need to reassure lenders. This inversion is critical. The empire still appears sovereign, but its priorities reveal otherwise. Stability is measured less by internal resilience than by external confidence. The audience has changed. Citizens experience this as stagnation. Not collapse, but a sense that effort yields diminishing returns. Opportunities narrow, obligations increase. The system feels heavier. None of this is dramatic enough to define an era. Only later do historians identify this period as the beginning of the end. In the moment, it is experienced as adjustment, as realism, as the cost of maintaining order in a complex world. The mistake is not borrowing itself. It is allowing borrowing to become the precondition for normal life. Once that happens, the empire's future is no longer open-ended. It is scheduled. The final unraveling, when it comes, will be attributed to visible events. But the outcome was shaped long before, when continuity quietly replaced capacity. The consequences do not arrive immediately. In many cases, they take a generation to become visible, sometimes longer. By the time they surface, the connection to earlier decisions is no longer obvious. The paperwork that created the dependency sits in archives. The people who signed it are remembered for other things. What remains is a system that feels older than its years. At first, the symptoms are mild. Growth slows, but does not stop. Public services continue, but without expansion. Infrastructure is maintained, not renewed. The economy still functions, though it feels less dynamic. At the time, this is interpreted as maturity. Empires, like individuals, are expected to slow with age. The explanation feels natural, nothing appears broken. There is no clear error to correct. Behind the scenes, however, the cost of past decisions compounds. Debt service absorbs a growing share of revenue, not dramatically, but persistently. Each budget cycle begins with fewer discretionary resources. Choices narrow further. New initiatives require justification not only in policy terms, but in financial credibility. This shifts incentives. Projects are selected not for long-term benefit, but for short-term reassurance. Investments that promise steady, predictable returns are favored over those that might transform productivity. Innovation becomes risky, stability becomes the goal. On paper, this looks prudent. Over time, the empire's economic structure adapts to this preference. Industries align with guaranteed contracts. Regions orient themselves around extraction rather than development. The state becomes the central customer, and predictability becomes the primary value. This is efficient, it is also limiting. When external conditions change, adaptation is slow. The system is optimized for a world that no longer exists, but abandoning it would threaten the very stability it was designed to protect. Citizens feel this as pressure without crisis. Taxes may rise slightly, fees appear where none existed before. Obligations become more formal, less negotiable. The relationship between the state and its population becomes more administrative, less reciprocal. Trust erodes quietly, not because the empire fails to function, but because it feels increasingly distant. Decisions seem driven by necessity rather than choice, by numbers rather than vision. At the same time, external actors gain influence. Creditors, trading partners, and intermediaries occupy a larger role in shaping outcomes. Their preferences matter because access to finance matters. This is not experienced as loss of sovereignty, but as realism in a connected world. Few object, the arrangements keep things running. This is why the final stage is often misunderstood. When a major shock eventually arrives, a war, a trade disruption, a technological shift, it is treated as the cause of collapse. In reality, it is the test the system was no longer built to pass. The response follows a familiar pattern. Emergency measures are taken, additional borrowing, temporary controls, reorganizations. Each step is justified as exceptional. Each one tightens the system further. The outcome is not immediate failure, but exhaustion. The empire continues, but in a reduced form. Its reach contracts, its ambitions narrow. Its influence becomes regional rather than global. None of this happens in a single moment. Decades later, historians debate when the empire truly ended. Was it the loss of a province, the defeat in a war, the dissolution of an institution? These debates miss the quieter truth. The empire ended when it lost the ability to choose its future freely. That moment rarely aligns with a headline event. It aligns with the balance sheet. Looking back, the mistake appears simple. It was not excess spending, not corruption, not incompetence. It was the gradual substitution of credit for capacity. Borrowing made sense. It solved real problems. It preserved stability when alternatives were worse. At no point did it feel reckless. That is what made it powerful. Empires do not fall because they make irrational decisions. They fall because rational decisions accumulate into irreversible structures. The lesson is not that debt is dangerous. It is that debt changes time. It brings tomorrow into today and leaves today responsible for promises it cannot revise. By the time this becomes clear, the world has already moved on. The empire remains, but its era has passed. The pattern does not belong to one century. It repeats because the mechanism is ordinary. It emerges wherever large systems attempt to stabilize complex obligations over long periods of time. It appears whenever continuity becomes the overriding goal. In the present era, the language is different. The instruments are more sophisticated. The scale is larger, but the logic is familiar. At the time, it still seems reasonable. Borrowing is framed as flexibility, as insurance, as a way to avoid disruption. The emphasis is placed on management, not limits. Models extend forward, scenarios assume stability. Confidence is measured daily. On paper, the system appears controlled. The difference is not moral, it is structural. Modern states possess tools ancient empires did not: central banks, deep capital markets, reserve currencies. These instruments extend the timeline, they soften shocks. They allow adjustments that once would have been impossible. They do not remove the underlying constraint, debt still reallocates time. It still assigns future capacity to present needs. It still narrows the range of choices available later. What changes is how long this can continue. In large economies, especially those whose currencies anchor global systems, the feedback loop is slower. The warning signs are quieter, the confidence of others becomes a stabilizing force. This reinforces the sense that the system is different. It is not. The mechanism does not fail because of size or status. It fails when dependency replaces option. When the system no longer functions without continuous borrowing. When stability itself requires constant reassurance. In such conditions, policy debates often miss the core issue. Arguments focus on spending levels, tax rates, growth projections. These are important, but secondary. The central question is rarely asked: how much future capacity has already been committed? This question is uncomfortable because it does not offer immediate solutions. Reducing dependency requires time. It requires accepting short-term discomfort for long-term flexibility. It requires political patience in systems designed for immediacy. At the time, such trade-offs feel unnecessary. The system still works, markets remain open. Obligations are met, confidence persists. The absence of crisis is taken as proof of sustainability. This is the same assumption empires made before. They did not collapse because they ignored warning signs. They collapsed because the warning signs did not feel like warnings, they felt like maintenance. In hindsight, the lesson is quiet. Empires end long before they fall. They end when their future becomes administratively allocated rather than strategically chosen. This does not mean decline is inevitable. It means direction becomes constrained. History shows that some systems recognize this in time. They restructure. They absorb temporary instability to regain flexibility. These moments are rarely celebrated. They feel like retreat. They feel like loss. Only later are they understood as renewal. Others continue forward, confident in their tools, reassured by precedent. They adjust at the margins. They extend timelines. They rely on credibility. For a long time, this works. The Roman Empire did not vanish in a year, nor did later empires. They transformed, contracted, and persisted in altered forms. Their end was not an event, it was a process. The same is true for any large system today. The question is not whether borrowing is justified. It almost always is. The question is whether borrowing remains a choice or becomes a requirement. That distinction determines not prosperity, but autonomy. In 2026, this distinction is rarely discussed openly. Not because it is hidden, but because it is abstract. Balance sheets do not evoke urgency. Timelines measured in decades do not fit political cycles. Yet history suggests that this is precisely when the outcome is shaped. The world's greatest empires did not disappear when they lost wars or leaders. They faded when they lost the ability to adapt freely. The war ended, the treaties were signed, the payments continued. Decades later, the empire was still there, just no longer in control of its future.